And now we're going to talk about the art. Again, as I mentioned in the intro, we're trying to take the art out of our analysis, but there's always going to be room for intuition and experience. We've gotten some questions on moving averages and areas where you think you're going to get resistance or support or so forth. We can't ignore all that, even though they might not be part of our system. So we're going to go over some of the reasons why you might want to be more aggressive than our guidelines are indicating, or maybe a little more conservative than we're suggesting.
Reasons to be more aggressive or more conservative. So this is a reason to be more aggressive. If the index breaks out of a base pattern or consolidation on heavy volume, this is one that, at the firm, when we see that, it doesn't happen all that often, but when it happens, we're going to really push things. And that could mean to be deeper in the market than maybe the count says, or you're just going to be in more aggressive names. We talked earlier about Chinese stocks and other risky stocks. A situation like this, that's when you would be heavier in those names. And we're going to talk about times to be more conservative, and that's when you're going to be in the slower, more pokey names. So this is the 98 very, very violent bear market. And as we came out of here, Bill was very, very aggressively buying Charles Schwab and AOL at the time. Those are the two leading stocks on full margin very, very early. He doesn't use the market school system, he uses intuition, and his intuition was telling him, hey, look, we've cleared above the middle of this W here, and we've just gone through this severe shakeout, which was a really deep, quick bear market. This is the time to push it. Doesn't mean it's going to work, but that's when you push all your chips on that side of the table. So that's what the firm was doing right there, and it really paid off. And here's a little bit odd one, because we have a lot of overhead. And typically when we look at a base pattern, we don't like to see a lot of overhead. But with a bear market, sometimes you're going to see situations like this. So if you step back from it, it's a very clear, well-defined cup with handle. And so right as you're breaking out into new high ground, our count was very high early on, but if it wasn't, you'd still be pushing it. If our count said 75% and you're right there, I'd probably be 100, certainly be getting on margin fairly quickly. And then here, this is after the 73, 74 bear market. So we came down, we had this nice little bounce off the bottom, and this is actually the S&P 500. We got a question earlier about other indices, and this is before the NASDAQ was around. So here's the S&P, very well-defined cup with handle. I've shown this chart to about every PM at the firm without it marked up. I was just curious, where would you be pushing it hard? Everyone said on this one day, because that's when you have all the evidence. This day is clear that the character of the market is changing, and that's the time where you really, really want to push it hard. And if you look at this chart and you don't see how critical that day is, that's fine. Just keep this chart and set it aside, and then maybe in a week or two or a month or at some point, you'll look at this chart and this day should just jump off the page. And really what you're seeing is a long drawn-out bear market with then a base at the bottom and a very well-defined handle. And you could actually even buy it here in a big way, but certainly by this point, the advantage when you're buying a pattern from an index is if it comes back in here, you know that there's something wrong because it's breaking your expectation. It's not breaking out and holding above. And this is exactly what you would expect. So that's how you use the patterns to be more on the aggressive side. Any questions on that? Yes, sir.
Like in this chart, the company analyzed prior to approximately, I don't know, maybe 30%. Do you have any charts which doesn't have that?
Well, the 1990, 91, this one. So you had a prior downtrend. Is that your question?
Yeah, yes.
And this is more normal. This is abnormal.
Okay, reasons that you might want to be a little more conservative than what our exposure count is indicating. At the beginning of a rally in the NASDAQ, get a follow-through day, but let's say another major index, say the S&P 500, moves to new lows when the NASDAQ just had a follow-through day, or shortly after the NASDAQ has a follow-through day. You might want to back away a little bit, or at least be on guard, because most of the time your indices are going to move in unison. It's very uncommon for indices to diverge by a great amount. And if you just look at history, most of the time the Dow, the NASDAQ, the S&P 500 typically move in the same direction. There was a period in the 70s where the NASDAQ really took off and the S&P 500 and Dow didn't do anything. But besides that period when the NASDAQ was a new, fresh, young index, it hasn't happened. So normally the major indexes are going to kind of support one another and confirm each other. So normally if you get a follow-through day on the NASDAQ, you'll end up with a follow-through day on the S&P 500 right around the same time and the other major indexes. So if you see that divergence occur, that is a reason to, if nothing else, be on guard that the other major indexes are running into trouble. The NASDAQ may run into trouble as well. Another reason that you may want to be more conservative is if the index acts in a way that breaks your expectations in a negative way. So, for example, we talked about this actually a couple times. This is the same time frame that we did the intro on. We were showing you how we were going to do the system. This is 2007. This was a time frame Mike and I are very, very familiar with. It was right before the peak of the market, right before the market went into that 2008 financial collapse. And that was the peak right here in early November. I remember this time frame because I was really struggling all year until this point, and in about a 2-month period, I almost doubled my account. It was just, Apple was going up like crazy, Google, Baidu, the market was on fire. And I was pushing really, really hard. And I remember that day. Now this is a day where you have a strong uptrend, you pull back, you move up to new highs here. I guarantee your account was probably quite high at this point. And the very next day, you get this expectation breaker. Out of the blue, you gap down from the prior day's close. That's the last thing you are expecting on that day, is for the market to react like that. And I wish I would have taken note of that. I didn't do anything on that day. And by the time we were down here, I was already 20% off my highs in like 5 days. So if you get an expectation breaker like this right out of the blue, something you don't expect, you can begin backing away faster than our sell signals might indicate. This might be a bad break perhaps, but other than that, this ordinarily would not trigger. Well, I guess you know what? You probably had a break below the last marked high. Yeah. You may have had a sell signal there, but feel free on a day like that to back away more if your portfolio warrants. By the way, this is a NASDAQ. The S&P 500 and Dow were already struggling at that point. Kind of goes back to the last point I made, was if your other major indices are running into trouble, maybe the NASDAQ is going to run into trouble. I had a whole thing I thought was going to happen. We're going to rally into the end of the year, and it just didn't work.
You kicked butt that year. So.
I had a good year, but it could have been better. So here it happened again. Now this was before the market really completely fell apart. Again, another expectation breaker. It looks just like the one we discovered. You break out, or just about break out, of this little consolidation. Things are looking good, and right out of the blue, boom, you're down. Now you would have broken below your 21-day moving average. You may have had some sell signals in here, but look how quick you corrected from there. You went straight down from that point. So if you see that kind of action, feel free to raise cash even more quickly. And probably your stocks are indicating that it's time to back away.
And just looking at this too, we were just talking about the patterns. Now it's not as well defined as the other ones we were looking at, but you can say this is a cup with handle, and that was the high of the handle that it was trying to break out of. And so it adds on to what he's talking about, the expectation breaker, because your expectation was that it was going to power out of there just like it did in the other examples. I mean, it's not a beautiful cup with handle, but I see it as a cup with handle.
And then another quick example of this, where you're in a downtrend here, you've got 4 successive lower lows, you're finally coming back up, pull back, and you're breaking out here. And it looks like the coast is clear, and then again, out of the blue.
So one day, all it takes is a day for an expectation breaker?
It's always a day.
Usually you're making tons of money, your account is up day after day after day, And normally the way they happen for me is I'm having a great day, and by the end of the day, I've had a terrible day. And you almost like, you're just slow in that regard. At least I am. I'm like, oh my gosh, well, maybe they'll come back. I just can't believe that my great day turned into a horrible day after a string. Usually, by the end of the day, I haven't done much selling, but the second the market closes, I'm thinking, why didn't I sell more? And I'm on the way home saying, why didn't I sell more? And it's usually the beginning of at least 3, 4, 5 really bad days. So I try to get quicker now to lock in where I am.
Another reason to be more conservative, there are few, if any, stocks with good fundamentals breaking out of sound base patterns. So that's the thing that Bill always says. If there's not stocks around, you're not going to be doing as much buying. And then if leading stocks in the market begin to fail, even though the market exposure remains high, you're going to look to see, is there industry group rotation? Is it earnings season? Is there a reason behind what's going on? But it's something that we're always aware of and something we teach at all the workshops. If the index you are following is coming up against an area of clear overhead resistance, such as a 200-day or a declining 50-day, and let's look at a couple examples. Charles really has a way to really see this coming and back away. He's very good at seeing that you're coming up here and saying, wow, you're coming up against a 50-day that's declining. You're probably going to go back and forth and possibly fall. So he'll sell into this. Now, our count is not going to be coming down for any reason other than maybe a bad break or some distribution. But really what we're saying is if you are running into resistance such as this or this old high, that you want to back away and be more conservative. And certainly by this day, you're realizing this resistance is going to be a problem. You don't know that this is going to happen, but you want to be backing away and being more conservative. On the offensive side, Charles will be selling into this, realizing this might happen. And if you can get to that level, that's a very good place to be. Now here, a very odd looking chart because you had this really bad day in here. And now you're coming up against a declining 50-day. And on that day, if that's all the information you had, it looks like it's going to be off to the races. But this declining 50 is just too much for it. And it's the same thing right here. So just some areas on the chart that we weren't able to write a rule for, but you're going to have to look and use your own analysis. And that's why it's part of the art. This one's a little bit easier to see and a little bit more obvious. I remember talking to Charles during this time, and I think he was pointing this out, where you're looking at these old lows, so that's resistance, and you're getting up there. Plus, this was a crazy time. Does everyone remember this time? I've never seen anything like it. Every day, up a bunch, down a bunch. It was worse than 2002, in my opinion. So it was just crazy, and you have a very steep 50-day. So you're going to be, no matter what the count is during a time frame like that, we could almost add another what if. What if the market is extremely volatile all over the place like it is here? You're going to be wanting to back away and be lighter in the market.